Trump's trade war: who wins, who loses? In a recent escalation of trade tensions, U.S. President Donald Trump announced plans to double tariffs on Canadian steel and aluminum imports to 50%, citing Ontario's 25% tariff on electricity exports to the U.S. as the primary reason. This move, coupled with threats to increase tariffs on Canadian automobiles and demands for Canada to lower tariffs on U.S. dairy products, has sparked concerns about the economic and political repercussions for both nations. U.S. perspective: potential benefits and risks. Benefits: protection of domestic industries. By imposing higher tariffs, the U.S. aims to protect its steel and aluminum industries from foreign competition, potentially boosting domestic production and preserving jobs in these sectors. Leverage in trade negotiations: the tariff hike could serve as a bargaining chip to pressure Canada into reducing its own tariffs on U.S. goods, particularly in the dairy sector, where American farmers have long complained about unfair treatment. National security argument: the Trump administration has previously framed tariffs on metals as a matter of national security, arguing that a strong domestic metals industry is essential for defense and infrastructure. Risks: retaliatory measures: Canada may respond with its own tariffs on U.S. exports, potentially harming American industries such as agriculture, automotive, and manufacturing. Increased costs for U.S. businesses: higher tariffs on Canadian metals could raise production costs for U.S. manufacturers reliant on these materials, leading to higher prices for consumers and reduced competitiveness in global markets. Strained diplomatic relations: the move could further strain U.S.-Canada relations, complicating cooperation on other critical issues such as climate change, security, and trade agreements like the USMCA. Canadian perspective: potential benefits and risks. Benefit: moral high ground: Canada could gain international sympathy and support by portraying itself as a victim of aggressive U.S. trade policies, potentially strengthening its position in future negotiations. Diversification of trade: the tariff dispute may encourage Canada to seek alternative markets for its steel, aluminum, and other exports, reducing its reliance on the U.S. and fostering stronger trade ties with other nations. Domestic industry support: Canadian industries affected by U.S. tariffs may receive government support or subsidies, helping them weather the economic impact. Risks: economic slowdown: higher tariffs on Canadian exports to the U.S. could lead to reduced demand, job losses, and slower economic growth in key sectors such as metals, automotive, and energy. Retaliation dilemma: if Canada imposes retaliatory tariffs, it risks escalating the trade war, which could harm its own economy and further disrupt cross-border trade. Energy sector vulnerability: Ontario's tariff on electricity exports to the U.S. could backfire if American utilities seek alternative energy sources, reducing revenue for Canadian power producers. Conclusion: the escalating trade tensions between the U.S. and Canada highlight the delicate balance between protecting domestic industries and maintaining healthy international trade relationships. While the U.S. may see short-term gains in protecting its metals industry and leveraging trade negotiations, the long-term risks of higher costs, strained relations, and potential retaliation could outweigh these benefits. For Canada, the immediate economic impact of higher tariffs could be significant, but the crisis may also serve as a catalyst for diversifying trade and reducing dependence on the U.S. market. Both nations must carefully navigate this dispute to avoid lasting damage to their economies and bilateral relationship.